Are you ready to find out why many traders, investors, and gamblers, just like yourself, get wrecked and go broke?
R1, R2, R3.
Back with that, buckaroos.
Now, the information in this video applies to whether you're a trader or an investor in traditional assets or crypto. It also applies if you'd like to go to your local casino and play a little blackjack, or perhaps if you'd like to play poker, or even if you'd like to go to the local track and bet on the horses. Now, this is all for informational purposes only. None of this is financial advice. Now, I want to tell you my nightmare when it comes to crypto. Now, if crypto goes to zero, I can live with that. That's actually okay. I had a good process, I followed it. Sometimes crap happens, and my thesis, it was just wrong. I was bullish when I shouldn't have been. That actually happens, and that's okay. Now, what is not okay is if I have poor risk management, poor trading, or poor investing, and I end up getting wrecked and going broke. Then, a couple months later, I wake up and I find out Bitcoin is at $100,000. Very plausible. I will not be able to live with myself if that happens. That is my nightmare.
Data coming back shows vehicle on course, on track.
My goal is to have all of us avoid that situation where we are right on track to make it to the moon and then we blow up just like that rocket. So in this video, I'm going to show you exactly why many of you will go bust and what you can do about it. The reason why many traders and gamblers get wrecked is a mathematical concept called gambler's ruin. Basically, there are a lot of slightly different definitions, but they all share similar traits. At the end of the day, what it really means is that all of you are completely underestimating the chance of you going broke. This is exactly why casinos make a fortune. They prey on this concept. Now, gambler's ruin has 4 key variables at play. 1, it's the odds of your trade or your investment edge, perhaps the odds of the table game that you're playing in the casino. 2, how do you manage your position sizes or your bet sizes? 3, time. How long are you going to invest or trade or gamble at the casino? Now, for traders and investors, it's basically infinite. We're going to be in the markets our entire lifetime. And a key variable is how much wealth the house or the market has. This is also infinite. It is my super small stack against the market. Now, first, I want to show you a concrete example on how much money can be made and how much can be lost to emphasize this lesson today. As most of you may know, I manage money professionally. And I took a lot of those concepts that I managed professionally with, and I built out a quantitative cryptocurrency coin selection model, which is focused on the liquid crypto market. These charts show the returns of the model if you invested exactly 1 year prior at various different points of time. Now, this is all out of sample. The top charts shows the performance of the coins that the model has recommended. Now, this is very diversified. You're investing in many coins at once. You're not putting all your eggs in one coin. Overall, the top picks of the model have returned about 8,500% per year. That's its annualized return. Versus the crypto market, which has returned about 246%. Now let's turn that into dollars. The model would have turned $1,000 into 2.7 billion. That's with a B. Now obviously that's very absurd going forward, but the point remains. It's still a crap ton of money. The crypto universe would have turned $1,000 into $62,000. That's still excellent. That's awesome. It's a great return. But what if you didn't have a strong edge like my model does? What if you actually had a negative edge? And this is what the model shows with the bottom chart. If you invested in the worst coins that the model identified, you would be bust or wreck exactly 1 year after investing or beginning to trade. But many times you'd be bust way before the 1 year mark. And this even includes those crazy crypto bull markets. So the difference here is huge. If you get it right, you can make life-changing money. If you get it wrong, you are almost certain to go bust. Now I'm going to show you a bunch of examples on how Gambler's Ruin will and is currently screwing you. Each example on each page will have 5 simulations of potential results to show you what might happen. Each simulation starts with me, CQF, having 5 Bitcoin, or $5 if you're a traditional asset person. I'm going against the house, the market, or the very rich Bill Gates. Each foe, they have unlimited money. The first example here is the worst case scenario. Unfortunately, this plays out every day in casinos everywhere at the blackjack table. And unfortunately, some traders actually trade in a very similar fashion, and they wonder why they go broke. The table minimum at this blackjack table is 1 Bitcoin, or $1. I plan on betting the minimum each time. The house generally has an edge of about 1% at the blackjack table, but honestly, I suck, so let's say my odds are about 45%. The question is, how quickly will I go bust? And the answer is extremely quickly. Like I wrote here, it's an instant bust. One simulation only makes it to 7 hands before it goes bust, and the best one lasts until 29 hands. That's not even enough time to get a free drink. The point is, if you play this game in this fashion, with these position sizes and these odds, you are 100% going to go bust. And very likely, it's going to be very quickly. Now, many of you are probably thinking, well, CQF, that's pretty darn obvious. If you have negative odds, you're going to go bust. Well, what if you actually have even odds? The first problem we're going to talk about today is actually related to risk management. And this is poor position sizing. This example is the exact same as the previous example, except I bumped up the odds to 50-50. So this time, think of it as a coin flip. I win if it's heads, Bill Gates wins if it's tails. I get 1 Bitcoin if I win, he gives me 1 Bitcoin if, well, I give 1 Bitcoin to him if I lose, and I get 1 Bitcoin if I win. Sorry about that. Now, many of you actually think in this situation, since the odds are 50-50, that your expected return is basically 0, or that you're going to end the game with 5 Bitcoin. You are 100% totally and completely wrong. This scenario identifies a huge problem in having a large constant position size relative to your stack. This is actually exactly why many casinos have table minimums. They wish to take advantage of this and make you fall into the trap. So in this example, compared to the previous one, you clearly get to play or flip, whatever the game is, a lot longer. The first simulation goes bust at about 16 flips, and the last simulation lasts to about 365 flips. However, what's important is if you play long enough, you will 100% go bust. And the reason is because of randomness, or what is called a random walk. Now, we don't necessarily need to go into the deep math, but what's really important to understand, there is something called a boundary. That boundary here is we, or CQF, cannot go below 0. We can only lose 5 BTC, which is our starting stack. Bill Gates can actually withstand any loss. At some point, no matter what, because of the random walk, I will actually hit that loss of BTC, where the game ends. And the problem here is my bet size is way too big and consistently at 1 Bitcoin. One way to fix this problem is to have a proportional bet or a trade size. Luckily, many traders already do this to some extent. they risk a percent of assets on each trade, or their holding is a percent of their portfolio. Now again, casino tables actually try to prevent you from doing so. The key point here is with proportional sizing that your trade or your bet size will then decrease as your account value decreases. I'll show you that here. So this leads to the next problem. Now you have a proportional position size, but it's still too large relative to their account size. You are not diversified enough given whatever edge you might have, and here it's still 50-50. In this example, I am risking 20% of my stack on each flip. There are still 50-50 odds on each flip. So the first flip, I'm risking 20% of 5 Bitcoin or $5, which is $1 or 1 Bitcoin that I'm risking. Now if I lose a Bitcoin or $1 and I have 4 Bitcoin left. My next trade is 20% of the 4 remaining. This time I'm actually only risking 0.8 Bitcoin. As you can see, my bets are actually declining as my portfolio or my stack declines. However, unfortunately, by betting 20% of my stack, each flip is just a matter of time. I will still 100% go bust if I play long enough. On the plus side, you get to play a lot longer. So if you're in the casino, maybe you can actually have some drinks. So what is the solution to this risk management or position size problem? You need a small proportional position size or bet relative to your account. Now there's no magic number I can give you. The exact proportion depends on the edge or how likely you're going to win a particular trade or a particular hand or a particular flip or whatever it might be. Now in this scenario here, I'm actually only risking 1% of my stack each flip. The bet is small enough that I'm able to withstand any randomness or losing streaks that are certainly going to happen. Now, there is still a chance you can go bust, but for all intents and purposes, you get to play this game as long as you want. And your expected return here is actually 0, meaning you should end with $5 or 5 Bitcoin. As you can see in the chart, there's still a bit of randomness involved. Now, many of you traders probably thinking, hey, I already do this already. I bet 1% or 2% of my capital on each trade. That's your risk that you're putting on the line. Well, now let's actually talk about margin, leverage, and stop losses. If your stop loss or liquidation price is too close to the current price, then your outcomes actually behave much closer to the constant bet example previously. Bitcoin moving 1 or 2% intraday will actually occur most days. In many ways, it's nearly all days. Given you still have that boundary, in this case it's the liquidation price or the stop loss, you are very likely to get stopped out based on random variation, that random walk. What this actually means in practice, your hit rate or your odds or your edge must be much higher than you actually think. Problem 3 here is if you actually have bad odds. Now most of you already probably recognize if you have bad odds in any game, you're going to lose and eventually go bust. But let's actually dive in here. Think of this as a blackjack table with no minimum bet size. Or perhaps Bill Gates found a trick coin that lands on tails 55% of the time, meaning I lose the flip 55%. Here I'm still betting 1% of my stack on each flip or each hand. Now I'm still going to go bust 100% of the time. If I play long enough, it makes sense, right? You have bad odds. And again, most people can recognize this. But the key here is actually look at how much longer you get to play when you have worse odds, here, but you actually have good position size management. You get to play very, very long to actually get a lot of drinks at that casino. Now here is the opposite problem. You have good odds. So this time I found the trick coin that lands on heads 55% of the time. So I have good odds, I have an edge, think trading, investing, whatever it might be, poker. The chart on the left shows if my position size management was 1 Bitcoin per each hand or per each flip. And this is the very first simulation we showed, except with the good odds. On the right is if I bet 20% of my stack per flip. Now this is actually very interesting. The result here is there's actually a chance you might win, but you're still very likely to go bust. Take a look at the chart on the left. You see 3 simulations went bust extremely quickly. And the reason you see the values for a couple continue to grow is because it got past the point where that random variation can make it go bust. And it continues to only bet 1 Bitcoin per hand or per flip. On the right, you actually expect to play a lot longer, but a similar scenario emerges. Some simulations still bust, but a couple can keep going and do decently well. Now there's actually a pro and some cons for large constant bets and proportional bets when you have this edge. In the constant trade scenario, you're much more likely to go bust quickly, but you're actually much more likely to have a scenario where you win and make a lot of money. And in the large proportional case, you're much more likely to play for a long time, for a while, but your chances of winning in the long run is actually much lower. That's because you're betting 20% on each flip or hand. Now, what's the ideal? This leads me to what you should be doing, or how you should be managing your money. If you do not have an edge, if you do not have winning trades, or you're not good at poker, or whatever it is, just skip this and come back in a couple slides. I'll tell you exactly what you need to do. In this example though, I still have my trick coin that lands on heads 55% of the time. So I have an edge, I have skill. However, here I'm actually only betting 1% of my stack on each flip or hand. Here, none of the simulations go bust. You should expect to win over the long run. Sure, some simulations could win more than others due to randomness, but they're all going to win. So what can you do? What does this mean for you? First of all, you need to be introspective and determine if you actually have an edge. Do you have good odds? Are you a good trader? If not, change what you were doing. The worst case scenario is for you to lie to yourself. For traders and investors, you must have a consistent, disciplined coin or stock selection process or trading process that is proven to work. When the bullets start flying, you have to stick to your process. You cannot change midstream. Now, I'm personally biased towards quantitative. I showed the results of my model earlier. Generally, quantitative models are much more proven and easier to follow without behavioral biases. But the reality is technical and fundamental methods work too. Regardless of what style you are, just be real to yourself and do not actively trade if you do not have that edge. On the right, it shows how you must have a good risk management plan. Now here I actually only covered position size management. That is certainly required as part of risk management, but it's not sufficient for an entire risk management plan. Some key notes on position sizes. First, bet a small percent of your portfolio. Do not bet constant amounts. And do not be like me. I go on tilt when I'm at the blackjack table. I'll start doing pretty well, then I'll start declining, and then I go on tilt and my bets get bigger and bigger. That is a guaranteed losing strategy. It's actually one of my own personal behavioral biases, and that's actually why I like quant strategies. Again, don't ask me the exact position size for you. It's a function of your edge. For example, if your odds were 100%, you should obviously bet 100% of your portfolio. As your odds decline, the amount you should bet also declines. Now guys, we need to actually be real. Most of you watching today do not have an edge. Only 1% of traders actually have true skill. It's very difficult to find people that can achieve what they call alpha or skill in the markets. However, there's still some good news. First and foremost, you can still learn. What you're doing here by watching this video certainly helps. Subscribe to my channel and you'll get more stuff like this. But there's a bunch of other good tools out there. You have books, you have other good YouTube channels, you have academic papers, and if you really wanted to, you can go back to school. But again, most importantly, do not lie to yourself. If you trade and you do not have skill or an edge, you will lose. You will go broke and you will get wrecked. So what else can you do? You can hire a skilled manager to manage your money. This is actually exactly what I do in my professional life. People realize they do not have an edge trading equities or building, big multi-asset class portfolios, so they buy things like mutual funds or ETFs. Now, if you want to still make the purchases yourself, there's still a method you can follow. Unfortunately, this is the despised buy and hold strategy. But what you want to do here is buy and hold an index, whether that's a stock index or a crypto index. For example, in crypto, you would either buy Bitcoin and hold it, or you buy a diversified set of coins and hold it, some periodic rebalancing. In traditional asset classes, you can buy the S&P 500 ETF, and you would actually get the return of the US large cap market. Or you can buy a bunch of ETFs to basically recreate the globe. Now, when buying something like the S&P 500 index, there are pros and cons. The pro is you will only go bust if the entire asset class, in this case, US large cap equities, go to zero. It's pretty safe to say that this is not going to happen. The downside is you have to deal with the volatility of the market, which can make you negative for a very long time. However, the benefits outweigh the cons here because you're going to get the return in the market in the long run, which should be positive, especially for equities and I hope for crypto. For casino gamblers, you need to recognize that no table game has favorable odds. Conduct strategies with position sizing to make the game last as long as possible. Milk the casino for a ton of free drinks. That also means only gamble with what you can lose, because you should expect to lose it. It's just entertainment dollars. However, some games like poker or betting on horses, the player can actually have a positive edge. They can have skill. Now, risk management can certainly be more complex, especially in poker. But a simple application of what we learned today will tell you that you should not sit down with your entire poker account at one table. You need to be able to withstand getting busted, going broke on that table many times before your account gets depleted. All right, guys, I think we are wrapping up here. Again, thank you for your time. I actually have an interesting story to tell you. If you made this far, you get a CQF Crypto Quantamental terrible joke. So when I was a kid, think like 8, 9, 10 years old, I went to some race with my parents and my extended family. They actually had a race car simulator. You get in, you act like you're driving, etc. I kept calling it a race car stimulator, that I wanted to get stimulated, which my parents and my uncles felt was extremely funny. And it took me a long time to figure out what the hell I actually did. But that's a interesting CQF story here. Anyways, thank you for joining me here today. I hope you actually learned what gambler's ruin is and how it's going to cause many of you, whether you're a trader, gambler, investor, to get wrecked. Plus, we also talked about some strategies on how you can begin to put the odds in your favor. If you like this content, please follow me on Twitter at CryptoQF and subscribe to my YouTube channel at Crypto Quantamental. In both places, I'll post coin buy sell picks from my quantitative model, Bitcoin updates, various educational content like this, some fundamental analysis, and occasionally some terrible humor. Again, thanks for joining, and I hope you have a great day or a great night.